Hey everyone, welcome back to another episode of my M1 Finance portfolio series where I'm attempting to reach a $100,000 portfolio in this platform M1 Finance. I always include an affiliate link down in the description below, so if you're interested in checking out M1 Finance, it's free to open an account, and if you use my affiliate link and end up funding your account, I might get a small commission, which would be much appreciated. But over this last month, I reached the rather unfortunate milestone of giving up all of my gains over the last couple of years. So we're down into negative territory for the first time, I don't think ever in this portfolio, but certainly in a while. We are completely negative on the all-time view, which is a shame. It's been a pretty rough first quarter of 2022 for just about all investors except for commodity investors. They've done quite well, and thankfully I do have some exposure to commodities in here, and I'll go over that in just a second. But let's review some of the biggest losers over the last quarter. I'll switch to quarterly view, see who has done the worst. Well, let's start with a big one that many value investors have added to their portfolios, and that's Alibaba. They have just continued to fall and fall and fall. My cost basis is at around $142 a share, and even that is no match for the now $86 per share that they've recently dropped to. Again, we have renewed fears of delisting. We have all of the problems that are kind of downstream from the Ukraine and Russia situation. There are people who are projecting that China might do something that would anger the US, and there might be financial sanctions or delistings or whatever. But in general, there's a lot of fear around Chinese stocks in general, and it's not to say that all of it is unjustified, but it certainly has been pretty intense, especially over the last 6 months to a year. And Alibaba just continues to get battered down, especially ever since Charlie Munger bought into it a little over a year ago now, if I'm not mistaken, and he's since doubled down twice since then. So it's interesting to see that you have such a vote of confidence from a very respected investor in the value investing space and just in the investing space in general. It has not been enough to outweigh the many fears that investors clearly have towards Chinese stocks, such as Alibaba. I'll probably be looking to add a little bit to this position in the near future, but I really don't want Alibaba to become a massive portion of my portfolio, as it's been more of a clone than anything else. I haven't done much intense due diligence into the stock. It just seems cheap relative to what they're doing. They're clearly a quality company if we're to believe the numbers out of China. And there are a number of risk factors that many investors have pointed out that I'm just not totally comfortable with to make it a massive portion of the portfolio, at least yet. Of course, things could always change, but it's still a significant holding nonetheless, and it's been a large chunk of the recent losses in the portfolio as well. On a similar note, I did lose a chunk out of Facebook. However, most of this has been added recently. You can see that 37% of 3,000 is not $621. This is a money-weighted return, so keep that in mind. It tries to factor in the timing of when you made your investments. And I've added quite a bit to this Facebook position in just the last month. My cost basis is right around $212 per share, and again, most of that has come in the last month. You can see kind of this jump up in late February, but it too continues to slide seemingly daily. Going on back to the main portfolio, if we head on over to the value slice, this is where some more big losers have come from. Foot Locker recently had some news. We can see it right here that Nike is trying to shift more towards direct to consumer sales, which hurts something like a shoe wholesaler like Foot Locker. So that obviously is not good news for them, but it's not to say that you still can't get a great deal out of Foot Locker. After all, they just announced that they're going to be doing something like $1.2 billion in buybacks, even though the company is worth, I believe, under $3 billion right now. Let's go ahead and check out the actual market cap here. About $3 billion in market cap, and they're promising to do $1.2 billion in buybacks. So massive portion based on current company metrics, at least. But it'll be interesting to see what happens to Foot Locker long term, considering the buybacks, considering what's going on with Nike. It's going to be an interesting sort of battle here, but if you can get it at a cheap enough price, it could potentially be well worth it. I added a fair bit pretty recently. You can see that jump here after it fell. That was me adding more money to this position. And again, we'll see what happens. Going on back into the value slice, another one that recently had a pretty significant pullback after a pretty significant run up is Turtle Beach, one of my largest holdings in my entire portfolio. I now have a cost basis of around $22 per share. It had gotten as high as the mid 20s pretty recently, and it's all the way back down to just below 20. And it's a very volatile stock. At least it has been over the last year. It's bouncing up and down, anywhere from down to about $17 all the way up to the mid 20s. And that's just in the last few months. It's been a pretty sporadic sort of stock price. But thankfully, the revenues are still up, although their cash flows are pretty far down from where they were kind of in their 2020 highs. Probably doing a more in-depth sort of breakdown on Turtle Beach pretty soon, kind of factoring in some of their recent earnings data. I think it would be warranted since it's such a large holding in my portfolio. But nevertheless, if we go to the 1 month view, it's been pretty painful, down about 10%. We head on back into the value slice. Another stock that's pulled back pretty recently is Smith & Wesson. Actually, just posted a breakdown on Smith & Wesson yesterday, so I'll go ahead and link to that in the description below if you want to check that out. And then Sleep Number pulled back quite a bit as well. Pretty much no one has had really positive earnings, and everyone is very fearful right now, not only because of the conflict that we're seeing in Ukraine and Russia and the instability that can come with that, but also the Fed's talk of raising the interest rates to try and combat inflation. That would not bode well for investors and businesses alike because you're making money more expensive. And when money is made more expensive, it's harder to buy things. It's harder to invest in things because the debt is simply more expensive. The cost of money goes up. And that's not a very good thing for such a debt-laden system that we have really throughout the world. But the one bright spot in my portfolio that I alluded to earlier is this actually metals slice. So it's all commodities focused, mainly gold, copper, and then silver and uranium as well, that have all done quite well, or at least not so bad. Certainly well in the last month. This is the 1 month view. Go to the quarterly view, it's up almost 20%. Commodities, especially metals, are a pretty interesting sort of asset in that often they're not very productive. In the case of copper, it really is a component in a lot of things, especially with electronics, batteries, whatever it is. So there's a lot of demand there right now. That's a big reason I have this in my portfolio. And uranium as well, used for energy, especially what we're seeing with oil prices right now. That's potentially going to continue to climb because Russia supplies so much oil to the rest of the world. And if multiple countries are going to start sanctioning Russia and not buying their oil, well, they're going to have to get their energy from somewhere. So long term, I was thinking uranium. And I bought into this holding well before that, but kind of on the assumption that if there's going to be a lot of energy demand, if inflation continues to rise, if the cost of oil continues to rise, you'd have some tailwinds for other sorts of energy sources like uranium. And then gold, I guess you could say, is a classic sort of fear asset in that as investors get scared of whatever's going on, they often flee to something like gold. It's obviously not a rule by any means, but you'll typically see in times like now where people are quite concerned about what's going on with inflation and with what's going on with the instability in the world. Gold has had a very good quarter, even though many other things have not had such a good quarter. You might notice that many of these are ETFs, which gives me broader exposure to these industries. And I just kind of wanted exposure to the various commodities here. I might even add more as we go along, just to kind of have a sort of inflation hedge. That was the initial theory here, in that as governments throughout the world, especially the US, continue to just print more and more money, lots of debt spending, you want to have something to park your money in that isn't cash. At least this is what I'm thinking. I'm not saying you should do it. You can do whatever you want. Cash certainly has value in that it's dry powder. You can do whatever you want with it. There's still plenty of equity risk here. If we go to the all-time view, you can see that I'm actually still down on this gold miners ETF, and I'm flat on the other one because gold has its ups and downs too, just like other stocks. And these are gold miner stocks. So it's actual companies that are exposed to gold. So you have both the commodity exposure, but then also the underlying company exposure as well. But I guess you could say that this slice is doing its job right now, in that it has sort of softened the blow of a market pullback that is also in an inflationary environment. So you ideally have some inflation protection here. Of course, it's not written in stone by any means. It's not as though this is always going to work. And if interest rates rise, I would expect many of these stocks to fall because they too are companies. And also when you make the cost of money more expensive and you reduce inflation, well, it makes buying anything more expensive. That includes something like gold or whatever commodity it is. But investors are piling into commodities right now, and that's largely due to the concerns with Ukraine and Russia. Russia supplies so many natural resources. Ukraine does as well, at least with agricultural resources especially, but there's a lot of natural resources that are tied up in this conflict. And that is a problem because when a large group of countries are no longer friendly with a particular country that has lots of natural resources, well, they're going to have to find those resources somewhere else. So investors see this, they're forward-looking theoretically, and they're trying to get ahead of this because they expect commodity prices to continue to rise as all of the supply is effectively taken offline. And that's on top of the already existing concerns with inflation and all the debt spending that governments keep doing and don't seem to want to stop doing. But as this article title points out, there is a recession risk with something like commodities, especially those more productive ones like copper, for example. If we hit a huge recession, there's less demand for sort of electronic vehicles, things that use batteries, anything that copper is a big component of, that could hurt copper because there's less demand for that copper. Right now, you have the problem of having pretty stable demand, if not heightened demand for many commodities, while you also have supply shortages that seem to be getting only worse, especially with this conflict and many other things. And when you have less supply and the same, if not more demand, you're going to get prices going up. But anyways, as for this metal slice, I don't really have a particular plan for it right now. My original thesis was that I would own these metal stocks, and then when a different opportunity came up, I could liquidate them and then move them into whatever the thing I wanted wanted to buy is. But I kind of like having some exposure to the underlying commodities. Granted, I don't want to hold them through euphoria because right now it seems like a lot of people are piling into commodities, which has me a bit concerned just for the long term. How much of this is just short-term speculation? How much of this is really a long-term fundamental shift that is actually going to sustain itself for a long time? It's very hard to say that. I'm not an expert again in any of these fields. It's just really to have some diversification there away from just holding fiat currency, I suppose. But I definitely would be at least somewhat inclined to pivot this into a particular stock if it fell hugely in price despite no underlying fundamental change. So that would be probably the big reason I would want to sell. It would be because I don't have the cash that I want to put into a particular position. So I would have to liquidate these metals and move that into that new position. I do want it to be more of a last resort though. But regardless, we'll see if we can get this number back into the green soon. I'm continuing to add money to this portfolio consistently every single month. Every time I get paid, pretty much, I'm adding money into this portfolio and continuing to try and grow it. Right now, even if there's a big market pullback, it's really not going to move the needle all that much since I'm continuing to add a lot of money into this portfolio. So really, I can replace a lot of market losses with new contributions every single month. I'd prefer not to have to do that forever, but for now, that's the case. Eventually, my stock portfolio in general will become big enough to where the actual investment gains will be what really moves the needle, not so much my actual contributions into the portfolio. But in any event, I'll be keeping you updated along the way. So if you like this video, definitely like it since that would help the channel out a lot. And be sure to subscribe since I put out a new update of this series every single month on the 15th. And check out all the free stuff in the affiliate links in the description below. But until next time, take care.